everyone, welcome back to my channel, Fast Stock Market News, and today I'm going to tell you guys what I've been doing during this brutal bear market in the NASDAQ. It's been pretty tough for a lot of us. I know we have a lot of our portfolios. Maybe some of you guys can beat me out. I'm actually down negative 24% on my stocks here on with SOFI. But honestly, I have massive conviction. I've made a video on SOFI if you guys want to check that out. But I'm going to tell you guys what I've been doing with my SOFI stock. So what I've been doing is I've actually been selling covered calls. If you're not familiar with what a covered call is it's basically selling shares, presuming that presuming that you don't think the stock price is going to go up. And as it stands right now, we're in a bit of a bear market. Selling covered calls is primarily a good thing to do when you're in a bit of a bear market, in a downtrend, because it's a way to possibly generate income, and I'll show you guys what I'm talking about right now. Important to know, before you sell a covered call, you have to have at least 100 shares of a company. As you can see right here, I have a total 2,000 shares of SOFI stock. So what you have to do if you want to sell a covered call is you go to trade options, and there'll be a lot of things here, but we're going to just cover right now covered calls. So buying a call is basically someone that'll let you're basically borrowing someone else's shares because you think they're going to go up, the price is going to go up by the end of the week. Selling calls, on the other hand, is basically what we're going to be doing. We're thinking the stock price is not going to skyrocket or go to a certain point by the end of next week. So in this example, let's say if I had a cost basis, or I had shares of SOFI stock currently at $7.23, and I buy about 100 shares of SOFI at $7.23, and I wanted to sell a covered call with a strike price of $7.50. So in return, the person that's buying the calls is going to give me a premium. They'll give me 21 cents per every share, which equates to, since we're selling a contract and each contract's worth 100 shares, 21 cents times 100 equals $21. I'll get $21. And the strike price is $7.50. However, because they gave me $21, my break even would be $7.71. So by the end of next week, April 22nd, if SOFI stock does not go above $7.71, I will make a profit. And even here, it shows you the possibilities. These are not 100% accurate, but it gives you a probability of what would happen. So if you check the chart right here, it says I have a 73% chance of that not happening. So it's pretty good odds. Because if you've noticed SOFI stock, it's absolutely been tanking the past week. So the chances are pretty high at this point. So what that means is, let's say by the end of next week, SOFI ends at $7. What happens then is basically I get the 21 cents, which is the $21, and I get to keep my shares. Now, let's say next week SOFI stock ends at $8. Now, it's a whole different story. I have to give up my shares, but I have to give them up at a $7.50 range because I was betting it wasn't going to go up to this price. And as you can see right now, it's $7.23. Let's say it goes up to $8 by the end of next week. At that point, I'm a bit of a bind, because now currently the SOFI price at the end of the expiration date of April 22nd is at $8. And I was betting it wasn't going to go up to that price at $7.50, let alone $8. So what happens now is I lose my shares. And on top of that, I lose money in the process because I was betting it wouldn't be up to $7.50, and I was going to collect the premium, but now it's at $8. At that point, I have to pay the difference because $7.71 up to the $8 is a difference of 29 cents. 29 cents times the 100 shares per contract, that's $29. So basically, I lost $29, I lost my shares, and I have to move on from here. You guys can see here, I actually have some calls that I was selling myself, and currently those calls are worth 2 cents to the buyer. So that's $2 per 100 contracts they're willing to borrow. You guys can see right here, I actually sold these calls on April 8th, and now they're starting to become close to worthless at this point. I've collected so far 80% of the premium, and the probability of me possibly losing my shares at this point is pretty low. if you guys go back to the options, one of the things that the buy, the call button does, it shows you the chance in order for you to break even. So at this point, SoFi's stock price would have to jump up at least 38.59% for me to lose my shares, my 300 shares. And currently, as it stands, that all gives you a chance of profit. I'm sorry. It's about 97.28%. So what'll probably happen is I'll let the week run until April 22nd, and these stock and these contracts will probably end up worthless. So at that point, what that means is I would collect 100% of the premium. So as it stands right now, so far, my contracts have generated me $24 of the $30. But by the end of the week, I'll get 100% of the full $30 by the end of the week, assuming SoFi doesn't run up to $10 plus at that point. So if, let's say, this strategy is actually a lot more beneficial if you don't wanted to sell weekly calls. Let's say if you think SoFi, as it stands right now, won't go up to possibly even $10 in the next couple of months, you could do call options that are a lot further out. In this example, you guys can see I'm going to do like something like June 17th. If I really didn't think SoFi was going to be up to $10 by June 17th, and once again, I have a total of 2,000 shares, I could possibly put $10 up to June 17th strike price. I don't think SoFi, as it stands right now, will go up to $10. And the person that's going to sell me or buy those calls is willing to give me 34 cents per contract. And once again, I have a total of 2,000 shares, so that means I can buy 20 contracts. So if we do the math, things to keep track of: June 17th expiration date, I will be getting 34 cents per contract per 100 shares, so that would be $34. And I have 2,000 shares, so that would equal $34 times 20. I would collect a total of $680, betting that I don't think SoFi is going to be at $10 by June 17th. So it's a risk reward when it comes to selling options, but it's generally a good time to sell options when you're in a bear market. It's highly not encouraged to sell options during a bull market, because as you guys know, if you were in the market in 2020, 2021, stocks can run up 30-40% in a week span. So it's something that's just to keep an eye out on, guys. If you do have over 100 shares of companies, selling covered calls is something you can do to generate passive income week by week, or you could do monthly call options as well. You can generate money that way as well. But one thing that I also wanted to mention before I leave, one last thing I just wanted to mention is that, as you guys can see here, my cost basis is $9.53. It would not be wise for me to sell call options at strike prices that are $7, $8, because let's say it does run up to that price, even though I collected a little bit more premium, I will lose the difference. So I'm selling options currently at $7.50, but my cost basis is $9.53. So that's basically about a $200 loss. You got the premium, but you actually lost shares at a huge price, about $200. So it's not wise to do that. I like to do, as I mentioned, I sell call options at strike prices that are above my cost basis. So it's something to keep in mind, guys, before you start selling calls. Thanks for watching Fast Market News, everyone. If you enjoyed the video, consider subscribing, commenting, or even liking the video. I'll see you guys next time. Take care, everyone.